Hey everyone, Tarek Backus here with Hold Net Worth, and in today's video I'm going to talk about how to start investing in real estate. Basically, I'm just going to talk about how to get started in real estate and what I would do or the steps I would do if I were to start investing in real estate today. I started investing in real estate in 2010 with one property, and since then I've acquired 3 properties. Nothing spectacular, nothing as big as some of the other YouTubers out there or other investors in real estate. I know there are people that have many properties, but I went at this pace because this pace is comfortable for me. And I have 3 properties right now. Again, 2 in the Greater Toronto area, 1 in Detroit. And then I also invest in stocks. I have a sizable stock portfolio that I'm growing. I like to diversify. I love investing and I love sharing that information. So this video here is actually going to be an 8-part video. I'm going to talk about the 8 steps for getting started in investing in real estate. And this video, I'm first going to talk about the analysis portion, but let me just run through the steps. So the steps that I created, or if I were to invest in real estate today, what steps would I outline to get started? Now, this is the way I would break down the shell. So my 8 steps would be, my first step would be to do a market analysis of the area that I want to invest in. And there's a lot of little bit of detail that comes with that, so I'm going to get into that a little bit later in this video. The second step is to secure funding. I'd have to get some sort of money, financing to purchase the property that I want to invest in. The third step would be to shop and actually look for the properties that I'm interested in, go around, go see houses, look at them individually, do a detailed analysis on them. That's what the DA stands for. You want to do a detailed analysis at that point on the individual property to see what the return would potentially be for that specific property and if it's worthwhile to go ahead with it. Now, if it is, the next thing you want to do is acquire that. And part of that process is to put an offer in, negotiate the offer. I am also a real estate agent, so I have a little bit of knowledge and experience with negotiating deals and what can help and how to do that, especially if you're looking at it from an investment perspective. So I'll get into that in that video. The next step would be to prepare the property. Your property is your product. You really want to get renters. You're going to market it to a potential tenant. You want to get a customer. Your tenant is your customer, and you really want to market the property to them. But to do that, you want to make sure you have a good product. So you're going to prepare your property as well. Next is you're going to market your property. Once your property is ready to be rented out, you have to find avenues to get it out there and market it so that people can see it. They see that you're offering a property for rent. And then the next step after that is once you get people coming in to look at your property and they're interested in renting or leasing your property, you're going to want to screen for the right tenant that you will have a relationship with as a landlord. And then finally, after that's all settled and done, you will want to manage it. You may want to manage it personally, or you may want to hire a property manager. That falls all under management. That might also fall under screening as well if you give that up to a property manager, but those I will get into at a later date. Specifically now, in this part 1 of the 8 steps, I want to specifically break down the analysis portion. What would I do when I'm doing a high-level market analysis for the area that I want to invest in? The first step is doing a market analysis. And in the market analysis, it's going to be a high-level market analysis. And what I would do is I would look for different areas that I'm interested in investing in. And when I figure out those areas, or I have an idea of, okay, this area looks good, that area might have potential. It might be, let's say, 2 or 3 areas around the city that you live in, or an area that you're looking to invest, maybe it's further out. But what I would do is I'd first look at and identify a couple of areas that interest me. Now, once I identify those areas, now this is just high level. Obviously, I didn't put in here, and maybe I should have. You kind of want to look at the area. Is it a decent area? Is there a lot of economic development in the area? Is the area being developed and looking for future growth, or you'll see that there's a lot of future growth happening in that area? Those are some factors that you want to look at as well. I'm not going to go too much into detail into the market analysis. This is more just a quick high-level step of what I would do, kind of a quick and dirty way. And I would first look at the home prices. I would look at the home prices in the area to see what are they selling for, or what are the prices kind of going for the houses that I'm looking to invest in. I would look at those prices, get a number, put an average together, put a range. Maybe it's between 350 and 450,000. Maybe it's between 450,000 to 550,000. Maybe it's between $425,000 to $475,000. I want to get an idea of the area, the type of house that I want, whether it's a townhouse, a semi-detached, or a detached home, what the price range is going for. And I might look at all three and do an analysis of all three. But let's just say we're picking one. For an example, let's say it's a townhouse and they're ranging in that area anywhere from, you know, 350,000 to 450,000, or let's say 375 to 425. That's probably a better range of where it might be, depending on, you know, how much renovations that the house has in it, what it has, and it might range from anywhere from 375 to 425. So I'm just pulling these numbers out my ass, but that's you know, based on experience, you might have that kind of range. But once I get that number, let's say, so this example, we'll say 375 to 475. I'm going to look for rents. What are the rents going in that area for that particular type of house? I look online. I'll look to see, you know, what that has rented for on some online websites like Zillow or MLS in Canada, and I would look to see what the rents are at. And let's say, for example, this is rent for that type of house is going anywhere from, you know, 1,800, or let's say 1,900 to 2,500, or let's say 2,000 to 2,500. Okay, so we're thinking a range of 375 to 425, and the rent is ranging from 2,000 to 2,500 per month. Okay, I'll go into the calculation a little bit later, but I want to look for these numbers. So I'm going to pull that price number, I'm going to pull the rent number out, and then I also want to have an area where there's low vacancy rates. So I would search online. A lot of municipalities or provinces, I think states have them as well on their government websites. You can find the trend or the previous year's vacancy rate, so you can kind of see how much vacancy there is in the area. Are those houses, or in that area, is there a lot of vacancy for rentals, or is the vacancy rate really low, so that you know that if you were to lose a tenant, you can rent it easily? Or if you were to purchase a property and you put it on the market, you know that it's not going to sit too long before it gets rented. So I would look into that as well. And then I would do a rough calculation. The next step is to go into a rough calculation and calculate the numbers to see what my return on investment would be. Okay, so once I've done all that analysis and I've got the area and I got the numbers, I'm going to go and do a rough calculation. So for the interest of this scenario, I said, you know, 375 to 425K, I think. So let's just round it off and say the house we're looking at, or that area, let's say we get the house in that area for about $400,000. So I'm going to just put this number down, 400,000. So that's the purchase price that, you know, if I pick up a property at around $400,000, you know, what would I get? And I said that the rents in that area were going to be around 2,000 to 2,500. So let's take a middle range. If this is 400,000, let's say we're going to get rent of 2,300 a month, right? So I'll just put rent is 2,300. I should put that here, rent, and purchase price. Okay, so the purchase price of the house is 400,000, and then 2,300 for the rent. Now, if I'm purchasing this house outright with cash, I can just do a simple calculation and divide, you know, 2,300. First I would multiply 2,300 by 12 and divide it by 400,000 to get my return on investment. Now that's probably not the case for most people. Most people will probably put some sort of deposit down and then get financing from the bank. And really, to be honest with you, if you were to do this, I'll just give you this example right now. Let's say we were to take and buy this house outright with 400,000. I have $400,000 of cash sitting in the bank. I'm going to purchase this property, and then I'm going to rent it out at $2,300 a month. I'm just going to do a quick calculation, nothing detailed yet. We'll get into more detail in a minute, but $2,300, I'll times that by 12. I'm using my calculator here, by 12. That gives me $27,600. Now I'm going to divide that $27,600 divided by 400,000, and then I'm going to multiply it by 100. That gives me a return on investment of 6.9%, not really good, but okay. I'm just comparing it to the stock market, where on average the S&P 500 would give you about a 10% return per year. So if this house is giving you 6.9%, it's not that bad. The only thing is, when you purchase a house, there's actually a lot more work involved and a lot more effort involved. And if I were to put more work into more effort, I'm probably going to want a higher percentage return than what I would get in the stock market. And this is not higher. 6.9% is not higher. So this is why leverage is so powerful, and I'll show you how. But let's say, again, $400,000 for the house price. You're going to rent it out for $2,300, and you're going to put down 20% as a down payment on the $400,000. So that's going to be $80,000. Now that's going to leave you with a mortgage of $320,000. Okay, so our purchase price is $4,000, so $400,000. Our rent is $2,300, and we're going to put down $80,000, which is going to leave us with a mortgage of $320,000. So that's the mortgage. Now let's say we get a mortgage and we're going to amortize it for 25 years at let's say 3% or 3.5%. I'm just going to do that on my calculator here. I have a mortgage calculator, so we'll do 320,000. Oh, come on. 320,000 at 25 years at 3.5%. That's going to lead me to around $1,600 a month for my mortgage payment. So my mortgage payment is going to be $1,600 per month. And now I also have to factor in, I'm going to do a quick factor in of insurance. And I'm going to say $100 for a rental property. Depending on the area, that might be a little bit high or a little bit low. It might be more on the higher end, but per month for insurance. And then I'm going to just say about, let's say $400 a month for taxes. That's roughly what it might be. Okay, so that's going to give me a total of $2,100 per month in expenses. Now let's just go over here. I'm getting $2,300 a month in rent, and I'm spending $2,100 a month in expenses. So what we'll do is we'll put the $2,300 here. We're going to put the $2,100 and remove it from the $2,300, which leaves us with $200 per month of profit in our bank account. In our bank account. Now, here's the little trick with it. There's a little bit of a different. There's something else we got to add to it. So that's pretty good. We're getting $200 a month. I'm going to multiply that by 12. That's going to give me what? $2,400 a year. So $2,400 a year. Now, if I do that, $2,400 divided by what my investment was. So my investment was actually, I should have wrote it here, was $80K. I took $80K of my own money and I invested it, and I took a mortgage. I financed the rest. So $80K. So let's do $2,400. Okay. Divided by 80,000 times 100 equals 3%, which is pretty crappy. I would not want to invest in this property at 3%. But there's a couple other factors. Now, in that mortgage payment of $1,600 right here, that mortgage payment of $1,600, you're going to have about just under half of it for the first year going towards your principal pay down. So paying down the principal of the property, which is actually building equity in the property. And every year that's going to increase over time. But let's just say for the first year, we're getting a little bit less than half. I'm going to say about $650. Let's say out of this $1,600, $650 per month is going towards paying down the mortgage. So now really I'm going to add $200 plus $650, and what does that give me? 2, 6, 7, 8, $850 per month. Now I'm going to multiply the $850 by 12. That gives me $10,000, $10,200. So that gives me $10,200. Now I'm going to divide the $10,200 by the $80,000. So I'm going to divide that by $80,000. And that times 100 is 12.75%. So this, divided by my 80,000, my down payment is 12.75%, which ROI, return on investment, which is fantastic. It's pretty good for real estate property. But again, the stock market is going to give me, or the S&P 500 historically will give me like 10%. And what do I have to do? I put my money in and I don't do nothing. With this, I have to do a lot more work. I have to, manage the property, do taxes, and I didn't even factor in, I didn't do a detailed analysis. I'm just doing a rough analysis. But from a rough analysis, it's going to give me about 12% return on investment. But now I have to factor in another factor. The factor is that generally house prices over time will go up by 5% per year. Now, depending on when you're buying this house in the cycle, you might be buying it at its height, or you might be buying it at the low end of the cycle. So it doesn't really go in a linear line just like anything else, but on average, you can bet that it would probably be about 5% over a long period of time. So let's say we're going to average a 5%. 5% on 400, I think, is 20,000. I'm really not good with numbers, but times 5% is 20,000. So now let's say a year goes by, I get 2,400 in cash, plus the 850 or 200 a month in cash, 650 in principal pay down, which gives me 10,200 plus 20,000. So let's just say 10,000. Let's just say 10,000 plus 20,000. For after the first year goes by, the house value increases to 420,000. So I have that in appreciative value. Not necessarily, it's not in my pocket, it's not in equity, but it's potential money. So now this is 30,000. Now I'm going to divide 30,000 by 80,000. So 30,000 divided by 80,000 times 100 equals a whopping 37.5%. My writing sucks. 37.5%. That is a fantastic number. And this is why real estate is very powerful, and leverage with real estate is very powerful for building wealth over time. But this is the way I would do a quick market analysis. I looked at that market, I looked at the range of houses, and now I see that, hey, there is potential here. I haven't gone into detail with, was I going out of the screen? Anyways, I haven't gone into detail with the analysis because I didn't factor in, taxes, I didn't factor in vacancy rates, and I didn't factor in property management or some maintenance as well. So that would eat into my numbers. That would, lessen these numbers a bit. I also didn't factor in closing costs. So this number here, this 37, this 12, might be a little bit less than what I had originally thought. But I can see that from this quick and dirty scenario that there's potential for me to get, anywhere from, based on cash alone and equity pay down, maybe, I'm just going through my head, maybe from anywhere from, 9 to 12%. And maybe from 30 to 37% with appreciation. So that's gonna kind of open my eyes to the area and whether or not this is an area that I'm interested in. Now I'll keep that in mind, and I might move to another area and do the same scenario and see what that area is. Maybe that area has a 40%, and that might be better for me to invest in that area. But this is what I'll do first. This will be my first analysis, the quick analysis to figure out if this area, this market is an area that I want to invest in. And then from there, I'll go on to the next step. So guys, I hope you found some value in this, and I hope you liked the video. If you did, hit the like button. Please do subscribe to the channel because I will be preparing and uploading the next video later on the next step on how to invest in real estate. Once again, thanks for watching, and hit the thumbs up and like and subscribe, and see you in the next video.